Welcome back to the Real Estate 401k show. I'm your host, Mike Weinstein, alongside Justin Frederick and Ryan Gerdes. You're going to want to text the word RATE to 623AZ Recon. That's RATE, R-A-T-E, to 623AZ Recon. All right, Justin, you're the lender. It's on people's minds. Everybody, wants to know what's going on with interest rates, and more importantly, what is going to happen with interest rates in 2025, I think in 2024. And in candor, I kind of fell prey to it. I got caught up in it. I really thought that in 2024, we were going to see rates drop significantly. It didn't happen. Why did it not happen?
Well, basically jobs have rebounded, and we've seen increasing number of jobs unexpectedly, and inflation. So we've been battling to get down to the target rate of 2% in inflation, and we were getting so close, and just not close enough. And then we start seeing those numbers tick up as the new reports come in, and they replace the previous year report, because inflation is calculated on a year-over-year basis, and we're seeing inflation go back up. People are still spending money. And we're employed.
Are they spending cash, or are they charging everything?
So that doesn't matter. That doesn't matter. Obviously, we're seeing the credit card debt balances go up. It's about spending money. It's supply and demand, and we're seeing products go up.
So the general consensus is rates for 2025 are expected to hover between that 6 and 7%, where it's doubtful. It's possible, but it's doubtful we're going to see a 5 in front of those numbers anytime in 2025. But is that what you're reading and your understanding, that that's pretty much where we're going to be?
Yeah, and actually we're seeing the 10-year Treasury note, 10-year Treasury bond continue to go up. If we see that hit 5%, there's a good chance that we could see an 8 in front of our interest rates this year.
Oh, that would be nice.
That's
right?
wonderful.
But it's
You're no fun anymore. I used to like you.
I mean, I feel the same way. But it could happen. It could happen.
So we've also talked about the correlation between the stock market and the mortgage-backed securities, and I know that we've kind of dabbled around it here and there on previous episodes, but dig in a little bit deeper on that and how that affects rates, if you don't mind.
Well, really, it's security within investments, and the stock market, is one of those risky markets. I mean, it really depends on what kind of stock you're getting into, though. But
I mean, on overall, like how it affects interest rates, because there's always been, it's always just been kind of reflective.
Yeah.
Like
so if
when
you
one's
see
stronger, the other one's weaker.
100%. So if you see the 10-year Treasury note going up, you're going to see mortgage-backed securities drop, and you're going to see interest rates go up. So general rule of thumb is if you're seeing the Treasury note go up, you're going to see mortgage rates go up. So it's a gauge for people to use. There is times where that's actually inverted, but it's not very often. In times like right now, it's right on point. And when you're seeing the 10-year Treasury note go up, a lot of times. So let's just use some numbers. So if you see the 10-year Treasury note go up, let's just say 4 basis points, you're probably going to see mortgage-backed securities go down probably 25 basis points, and so you're going to see mortgage interest rates increase by 25 basis points.
And how long does that reaction take? So it goes up 4 basis points on the 10-year bond. Is it immediate?
It's immediate.
Okay.
It's immediate.
Okay.
Yeah.
All right. Well, a lot of this information that we're referring to comes from a fantastic article. If you have questions about mortgage rates or would like to talk to Justin, or just even get a hold of this article, all you got to do is text the word RATE to 623AZ-RECON. That's RATE to 623AZ-RECON. All right, Ryan, so as far as on the strategy side goes, I think what we are seeing, And I think a lot of consumers, there are consumers out there that are still waiting for rates to get into the fives. But I think everybody, for the most part, understands that rates are going to be somewhere in the, between 6 and 7%, causing a lot of homeowners now to put their home buying process on pause until it becomes much more affordable. What is the danger of that? Is that a good idea? Is that a bad idea?
There's two reasons why people transact. Sometimes because they need to, and because they want to. So if it's because you want to, then you better have a good strategy behind it. If you need to, then you're kind of stuck with what you got. You can still implement some strategy there. It's never been more prevalent in the market that there's been more creative financing. So there's a lot of different opportunities out there. Notably, ones where if a seller has a 3% interest rate on their current mortgage, and let's say they want to sell their home for $500,000, their mortgage currently on it is at $400,000 at 3%, then figure out a way to beg, borrow, and steal that $100,000 so that you can have the seller carry that mortgage over to you. And because we are seeing a little bit higher days on market, we are seeing some more motivated sellers. Giving them that, making them whole by giving them that full 100,000 rather than trying to nickel and dime them for, instead of 500, I'll pay you 475. Then you can see them be a lot more open to opportunities like that. So we've seen some good negotiation results because of that. But if you're going to go over there and try to have your cake and eat it too, sellers are not quite that hard up yet. So they're going to remain a little bit more stubborn. So if you're going to walk to the negotiation table and try to do that, you're probably going to find a lot of failure in that. We've talked about new home builders in the past. They're still offering extremely competitive rates. So those are some good opportunities there. If you fall into the bucket of wanting to buy rather than needing to buy, then you've just got to be ready to make some compromises, and you have to be ready and willing and able to pay the piper, because I don't think that we're going to see a 5 in front of interest rates.
Well, and for me, and I should have got the exact numbers, but we actually saw a pretty decent uptick in the amount of listings in the Arizona Regional Multiple Listing Service this week, considerable amount. And so going back to then strategy, Justin, I had a conversation with one of our clients yesterday. We were talking on the phone. He goes, "All right, Mikey, give me some good news. Rates going down." I'm like, depends on how you look at it. I go, rates are going to be between 6 and 7%. And he goes, man, that's really bad news. I go, it's not really bad news, because there's certain strategies. I still always maintain that a higher interest rate means a better deal on the house. We're seeing an uptick in inventory. Rates are going to remain between 6 and 7, so it is going to be keeping people out of the home buying process, therefore leaving sellers a little bit more willing to wheel and deal. And so, long lead into the question, Justin, because what I explained to our client yesterday is our strategy for you is we're going to negotiate a good price. You're going to take the higher interest rate, but we are going to still negotiate with the seller and get them to pay, possibly pay for, a 3-2-1 buy down, so that, if interest rates today are 7, year 1, your interest rate's going to be 4, then year 2, 5, and then year 3, 6. So you get a stellar interest rate for the first 3 years. And then at some point when rates do drop significantly, then you kind of slide on in there and do a refi.
I love the temporary buy down strategy still, as long as it's a term that you still understand what your note rate is, because you gotta be able to afford that note rate, and
Still got to qualify.
Yeah, you still got to qualify. In some cases right now, just based on there's no indicators in the near future that we're going to see some lower rates. Maybe even get a good portion of money to do a permanent buy down. You might not hit that 4.0 range, but maybe a high 5. if we can get a significant amount of money to put towards a permanent buy down.
And if we can get the seller to pay for it, or at least pay for
Right.
a good portion of it, it's a win-win.
Correct. So, I mean, it really depends on how much money we're getting from the seller, and what the goal is for how long we're going to stay in the home. If we're planning on eventually renting this out, and how long, because if we're planning on renting it out a year after moving in, we don't want to be in a temporary buy down, because then when we refinance it, it's going to be an investment property. So there's just ways we could look at it, but there's absolutely a lot of different products out there that we can look into if we can get some money from the seller. In a lot of cases, if we're going after that permanent buy down, it's not so much the money off the home, it's really the money that we want to get towards the rate buy down that's going to save money over the life of the loan. But again, it all depends on what our goals are, right?
Yeah.
I know a lot of people want to get the price of the home down, but right now, that number in front of that interest rate's a big deal.
All right, if you'd like some more information about mortgage rates, and more importantly, these permanent or temporary buy downs that Justin is referring to, go ahead and text the word rate to 623-AZ-RECON. That's rate to 623-AZ-RECON. So the group of people, my question, Justin, is the group of people at the end of the day sit around a table and determine where mortgage rates are going to be at, right? Do you think in their mind that they have an ideal number where, for the health of the nation, for the health of the housing market long term, rates really should be in the 6 to 7s, and buyers should just get used to it? Because, I was reading this article, and I've heard this many times, one of the factors that we could see where we might see a 5 in front of that number in 2025 is if we experience some sort of recession. So to me, a recession means people are struggling, and the response is, well, let's just lower mortgage rates. So leaving people with money going, man, I'm really praying for a recession, or, pay for a recession. But is there an ideal number? Like this is where we should be?
So, I mean, that's above my pay grade, but I'm going to say that, yeah, I feel like the rate should be between 6 and 8%. In 2008, before we had all the market crashes, I mean, we were sitting at 7.75 for pretty much the entire year, before we had all these problems with option arms and things like that really created a problem for us. But I do think that a healthy market, you should see rates between 6 and 7. And I know that's a hard pill for a lot of people to swallow, because we've been used to for 11 years we had rates that were
Historic.
sub 5, but they were absolutely historic. And I mean, we had, out of those 11 years, I think we had 5 years where rates were in the 3s. And there was periods of time where we were locking 2s, and there was a small period of time where we were locking 1s. But we should never see that. I mean, prior to 2009, when we saw that massive rate reduction in November, the last time the rates were that low was World War II.
Wow.
So that tells you, I mean, that was a huge chunk of time that we were. I mean, yeah, there was some periods of time where it was it was very short lived where it was lower, but not for an entire year. So. Yeah, in World War II, we had some problems there, with production, supply, and demand, because everybody was working on
battleships and bombs, and stuff like that. Yeah.
They had the women working in industrial plants. So, yeah, unfortunately, it does take the economy to be in shambles or on its way to shambles in order to start seeing rates like that.
Well, you did bring up something earlier that I think is something that should be mentioned as kind of a trickle effect of all this. I think that between this year and next year, we're going to start seeing a lot of movement in rental rates.
I agree.
You think up or down?
I think up.
Oh yeah, they're going to go up significantly. Number one, a lot of different states are starting to increase minimum wage again. And so people are going to even, and that usually is reflective of people that are renting properties, because most of them, are either closer to the minimum wage or are at minimum wage, and they're the ones that are generally renting. That's unfortunately a fact. And so as they get paid more, they're going to rent more. And a lot of the inventory that we are seeing are investors that no longer want to hold on to these rental properties. And we're experiencing that in the trenches right now. A lot of our clients that are stepping forward saying, hey, we want to sell this, those homes were rental properties. And we have been in pretty saturated in our local market with a lot of rentals. And so I think this is going to be probably the year where we see a lot of liquidation on that. And then probably either late this year or early next year, we're going to start seeing some rental rates increase quite a bit because there's just not going to be enough inventory. So, and rental rates are always, like a couple years behind interest rates. They just that's how long it takes to tail them. Because either the investor loses interest or the tenant loses interest, right? They just say, to hell with it. It's going to be cheaper to own than it is to buy, or cheaper to own than it is to rent. So that's when they pull the trigger. Now, once it becomes equivalent, the same amount that it costs to own as it is to rent, that's when people start buying again. Yep. So that's why we've kind of seen a lull in the market in the past year, because interest rates went up so high that investors had to put down 50-60% in order to even break even on what their mortgage was going to be. So I think that we're going to see a lot of shifts there.
It's been just looking at some of the market rents too. They're just incredibly cheap when you're looking at what these 30-year fixed payments are to be a property owner. And I feel like there is a lot of people out there right now that's like, wow, it's much cheaper to rent. But yeah, I do feel like your investors. I'm one of those. I gotta increase the amount I'm charging for rent. Just understanding that it costs so much to
everything
to occupy a home now.
Right.
All right, well, there you have it. If you'd like some more information on the home buying process, investing process, and to know where you stand as far as rates go, and more importantly, to get more information about these temporary and permanent rate buy downs, all you got to do is text the word rate to 623-AZ-RECON. That's rate to 623-AZ-RECON.